If your charts look like someone took a can of silly string to your computer monitor, you're probably doing something wrong. Hey, I'm Robert Roy of WealthBuildersHQ.com, and today we're tackling a topic that confuses way too many traders: indicators. I'm going to show you exactly how I use them, which ones actually matter, and most importantly, how to avoid the biggest mistake most traders make with them. Here's something that might shock you. Loading up your charts with every indicator under the sun will not make you a better trader. In fact, it usually does the opposite. I've been trading since 1997, and I can tell you that simplicity is the key. So why might having a large number of indicators on your charts be unhelpful to you? Let me give you an example. If you're using indicators like stochastics, MACD, RSI, guess what? They're all oscillators. Yes, they have different purposes and different ways to read them, but you could look at each of those three indicators on the same chart, and one might be bullish, the other one might be bearish, and the third one might be I don't know-ish. In other words, you're getting three different signals, and which one do you pick? Well, I like that one better because it's doing what I want it to do. No, you're making a mistake. You don't need all of these indicators. Now, with that in mind, let me share the three core indicators that I use in my trading, and more importantly, why I use them. So the first one is moving averages. Now, I use an 8 and 21, and they're exponential EMAs, exponential moving averages. Many people will use a 10 and 20. There's not much of a difference. The biggest difference is they are Fibonacci numbers, and since I have back-tested 4.5 million days of moving average crosses, and I found the 8 and 21 to give me the best trading cross for the signal that I look for, so that's why I use the 8 and 21. Now, they are a very dynamic set of indicators, and there are great entries that can be taken with them, but I use them in correlation with another indicator, and that's indicator number 2, which are Fibonacci. Fibonacci is a series of lines or levels that are drawn on a chart from what are called a swing low to a swing high if the stock had a bullish move, or for a swing high to a swing low if the stock had a bearish move. And it's very specific setups of exactly what we're looking for. Once you've got the swing high and swing low, now a series of lines are drawn automatically. You do nothing. It just puts those lines in place for you automatically. They are known as retracement levels. Those levels are key to making a trading decision. So if I have a retracement level, a Fibonacci level, and my favorite one is a 0.618, it is the purest, most important number in the universe. Look it up. It's even in your DNA. You have a perfect 0.618 to 1.618 relationship between your major and minor DNA. Enough of the science class, right? Back to the trading part of it. If you go ahead and see a stock move back to that 618 and it starts to bounce, that's a good signal. It's a great signal if my moving average happens to be there at the same time. Now I have a confluence of two different indicators in the same place, two different groups of traders. The Fibonacci traders and the moving average traders are both watching the same thing for different reasons, and I've got a higher probability of being right in that trade. Number 3 is volume. Now, listen, you can look at volume in many different ways. The first way I look at it is I need a minimum every single day of 1 million shares traded. That's the first thing for it to even make it to my list. And then depending on the trade setup, you want to see possibly as we bounced off of that 618 Fibonacci level where the 8 and 20 moving average were, you'd like to see volume start to increase there because that shows, it proves to you that traders are supporting the overall move. Now, here's the mistake that most traders make. They use the indicators as a crystal ball, trying to look out into the future, trying to predict where the market is going. But here's the truth. Indicators are lagging. They tell you what's already happened. And while they can help determine where prices are more likely to move, they're not going to tell you exactly what will happen next. Instead, here's how you should think about indicators. As I already mentioned, Fibonacci moving averages, they're a confirmation. Using all of your technical indicators together for Confluence, they give us a confirmation. They confirm what you're seeing from one thing is happening on another as well. They help you manage risk by providing clear and concise entry and exit points. Now, they can also help you remove emotion from your trading decisions, right? Remember this, the best trading setups happen when multiple indicators line up to tell the exact same story. This is called a confluence, when you see price respecting a Fibonacci level and it's lined up with a moving average, while volume is increasing. And your moving average is confirming the direction that when you have a high probability setup, that's when you have a high probability setup. It's kind of like putting one piece of sheetrock on the wall or putting a piece of sheetrock and then a piece of plywood over it. It's a heck of a lot harder to break through. If you want to dive deeper into how I use these indicators in my trading, join me every Monday at noon Eastern Time for Power Hour, a free weekly training where we analyze setups live using these exact techniques. I break down what the market is doing now, and I analyze your stock picks. Go ahead and click the link below to get signed up. Until next time, make it a profitable day. Stay focused on the quest to becoming a great trader. Keep crushing it, and remember, you're just one trade away. Go ahead and click here for another one of our great trainings.